You've been told that maxing out your 401k and employer match will lead to comfortable retirement, but the reality is more complex. While these accounts offer real benefits, there are hidden costs, limitations, and alternative strategies that many people never learn about. Today we're going to examine what's working, what isn't, and how you can optimize your retirement strategy beyond the conventional wisdom. Number 1. The hidden cost of high 401k fees. Let's examine something many people overlook: management fees in your 401k. While fees vary widely, a 1.5% annual fee, which is on the higher end, means paying $1,500 every year on a $100,000 account, regardless of performance. While average 401k fees typically range from 0.5% to 1.2%, even these seemingly small percentages compound significantly over decades. Number 2. The real story behind employer matches. Here's the complex reality behind employer 401k matches. While companies did shift from defined benefit pensions to 401k plans, partly to reduce long-term financial liabilities and transfer investment risk to employees, the employer match wasn't designed as deception. The transition was driven by multiple factors: changing workforce mobility, regulatory requirements like ERISA, accounting rule changes, and genuine cost management needs. Companies found 401k plans more predictable for budgeting, but calling it purely calculated manipulation oversimplifies a complex economic shift that involved real trade-offs for both employers and employees. Number 3. The vesting trap. And that's only part of the story. Most employer matches come with vesting schedules, meaning if you leave before a certain number of years, you forfeit their contributions. This isn't about helping you retire, it's about trapping you in your job. The median employee tenure in the US is approximately 4.1 years, though this varies by age and industry. Number 4. The inflation factor. Inflation does impact retirement planning, but it's not the hidden destroyer many claim. While $1 million in 30 years will have the purchasing power of about $410,000 in today's dollars, assuming 3% inflation, proper retirement planning accounts for this. The key is focusing on real returns, your investment returns minus inflation. If your 401k earns 7% annually and inflation averages 3%, your real return is about 4%, which still builds wealth over time. Number 5. Understanding 401k contribution limits. The government sets annual 401k contribution limits, $23,000 for 2024, primarily for tax policy reasons, to manage the cost of tax deferrals and prevent excessive tax advantages that would disproportionately benefit high earners. These limits help maintain government revenue while still providing meaningful retirement savings incentives. Wealthy individuals typically maximize their 401k contributions as part of a broader investment strategy that includes taxable accounts, IRAs, real estate, and other vehicles. The contribution limits don't prevent wealth building, but rather ensure the tax benefits are distributed more equitably across income levels. Number 6. When markets crash. Here's the reality nobody wants to face. When you're ready to retire, you have zero control over market timing. Imagine you're 65 and ready to retire in 2008. Your 401k balance would have declined significantly over the following months as markets crashed. Unlike a pension that guarantees payments regardless of market conditions, Your 401k balance is subject to market volatility. Number 7. The withdrawal trap. But wait, there's more. Even after decades of contributing, the government still controls when and how you can access your own money. Touch it before 59 and a half and face massive penalties. But here's the kicker. Once you turn 73, or 75 if born in 1960 or later, they force you to withdraw money whether you need it or not, pushing you into it. Number 8. Who benefits from retirement systems? Multiple parties benefit from retirement investment systems. Fund managers earn fees for portfolio management services, typically 0.52% annually. Employers save costs compared to traditional pensions, while still providing employee benefits. Governments collect taxes on withdrawals, but also provide tax deferrals during contribution years. Investors benefit through professional management, diversification, employer matching, and tax advantages, though they do pay fees and face market risks. The system creates value for participants despite its costs. Number 9. What actually works? The wealthy build retirement security through assets they control: real estate, businesses, and investments outside the 401k system. They use 401ks for the immediate tax break, then focus on building wealth through appreciating assets that generate cash flow. Instead of hoping a managed fund will perform, they create multiple income streams that aren't dependent on market performance or government rules. The secret isn't saving more money in retirement accounts. It's building assets that pay you regardless of what Wall Street does. Your 401k should be a small part of your strategy, not the entire plan. The retirement crisis isn't coming. It's already here. Millions of Americans are discovering their 401ks won't cover basic living expenses, let alone the retirement they were promised. But now you know why. The system was never designed to make you wealthy. It was designed to make you a reliable revenue stream for others. Start building real wealth through assets you control, not accounts controlled by others. Your future self will thank you for seeing through the scam.